Good evening, everyone. Welcome to this session, online session on Consolidated Statement of Financial Position. You are all welcome to the session, and good evening, everyone. Again, this evening we'll try as possible to ensure we are efficient in our timing, and we'll also ensure that we actually deliver the course in a manner that is understood by participants, and where question is required or necessary or further clarification is required, please endeavor to use the chat box, and you can also signify by raise of hand on using your icon, and that's how we're going to approach it. And automatically you find out that everybody is on mute, and it's only upon raise of hand that you can be granted access to more or less talk on the platform. Okay, and also we'll ensure we make it much more interactive. Okay, so that we can be able to appreciate the whole essence of coming together at this point in time to have this deliberation. I remain Olumiwa Adebayo, who's going to tutor you for this night, okay? And as far as practicable, I will appreciate if some or all of us can put up our cameras to make it much more lively, okay? Now, today we'll be discussing a little about Consolidated Statement of Financial Position. That's Consolidated Statement of Cash Flows. Okay, but the knowledge here is premised on the fact that you have an understanding of the statement of cash flow of a single entity. Okay, that is what it is premised upon, given that you have the understanding of statement of cash flow of a single entity. Okay, as certain references will be made. Secondly, this is also premised on the fact that you have understanding of the requirement of consolidation, all because we'll be making reference to one or two things we're supposed to have learned in the process of preparing group accounts. And that also will be one of those preconditions to participating in this class. Okay. And that is how we're going to start. Now, remember, in the process of consolidation, we all emphasize that consolidation entails the combination of the financial statements of the parent and the subsidiaries as series of a single entity. And if you go by the requirement of the conceptual framework, we have five components of financial statements, namely the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flow, and rather the note to the financial statements. Now, one of those five components is a consolidated statement of consolidated statement of cash flow, which in this case is what we are taking into consideration. And on that premise, we will be making much more reliance on our understanding of the whole process of consolidation, okay, and also our understanding of the requirements of IS 7. And let's start. Cash flow statement tends to depict as against other bases to which we have accounted for other statements. And what does that mean? What I'm trying to say is that, remember, we have two bases of accounting. One is the accrual basis and the other is the cash basis. But accrual basis underline more or less the process or the system or procedure to which financial statements are prepared in generality. Okay, whereas there's an exception to that rule. Such an exception is that of the statement of cash flows. And what that signifies invariably is that statement of cash flow deviates from the adoption of accrual basis of accounting. Rather, it adopted the cash basis of accounting. And what does that tend to depict? it tends to depict that rather than just look at profitability or financial position, what is the cash flow status of the company in terms of its liquidity position? Okay, and in that manner, we tend to understand how is cash generated within a business and how is cash utilized within a business. Okay, and not only that, cash generated and utilized based on organic activities of the business, which has been identified to be three, starting from the core activity, which is also known as the operating activity. We also have other two activities such as investing and financing activity that is also critical to the entire process. And that is why you find it worthy to understand that there are three key activities within the statement of cash flow: operating activity, investing activity, and the financing activity. Similarly, as that applies to single entity, it also applies to that of a group. Okay, but in preparing group statement of cash flow, there are critical things we need to consider. And that is why we need to have this understanding. And to understand that, there are four cardinal points to which you can better appreciate and understand the requirements of preparing consolidated statement of cash flows. Now, the first aspect of it, which we are going to look at, is the issue regarding non-controlling interest. We all know what non-controlling interest stands for, as the interest in a subsidiary or in the group as a whole, other than that of the parent. Okay, that is the first thing we are going to look at. What is the implication and what role does the treatment of non-controlling interest play in preparing consolidated statement of cash flow? The second aspect is treatment of associate and joint venture. Okay, why did I add joint venture? Because associate and joint venture are more or less treated in similar manner in line with the requirement of IAS 28. And therefore, what role and implication does that have in the whole process of presenting consolidated statement of cash flow? The third one is issue that borders on when there is an acquisition of a subsidiary during a financial year. Okay, we are all familiar that when there's acquisition during the year, there are critical things we need to consider. Now, when we are presenting the statement of consolidated statement of financial position, and likewise under consolidated statement of profit or loss and other comprehensive income, you find out that we are much more painstaking and careful when we come across acquisition during the year, due to the fact that certain considerations have to be more or less taken into action so that we are able to show the true financial position and performance of the entity. Now, as a result of that, we also take such careful steps when we get to consolidated financial statements. And we are going to look at those steps and those critical requirements and the reason behind such action as we get there. As it affects acquisition of subsidiary, so does it affect the disposal of subsidiary? Okay, even though in your curriculum at this level, okay, which is the skill level of ICAL, you are not yet exposed to disposal of subsidiary. But again, whether you are exposed or not, the principle here is so clear, and the principle can be likened with that of acquisition, which means acquisition is addition of a subsidiary to the group, while disposal is the more or less removal of a subsidiary within the group. Okay, these are the four things we are going to consider in the whole process of trying to establish our understanding on how do we consolidate statement of financial statement of cash flows of a subsidiary with that of the parent. And we are going to have some information here, starting from the fact that we are provided with the consolidated financial statements with respect to profit or loss and with respect to the balance sheet. And what then do? We are provided with additional information, and on that premise, we are to consolidate the cash flow statement or the statement of cash flow of the parent with that of the subsidiary. Okay, that is that. That is just an introduction before we move into it. Now, let me start with a basic principle that we need to understand. Now, let's assume, let me try and share. Consolidated statement of cash flow. Now, in a nutshell, if you could recall, that group accounts is the account of the parent and the account of the subsidiary. Assuming we have a simple group, as C is the account of a single economic unit or entity, as the case may be. Now, what makes it so is because of the adjustments that is required at every point in time. And we are familiar with the adjustments when we were consolidating the balance sheet. Likewise, we are familiar with the adjustments when we are consolidating the statement of profit or loss. Now, what are we to do at this point in time? Is that if we go by this doctrine, it then means that if I have, for example, for simplicity's sake, I have the parent and I have the subsidiary. All figures in thousands. Let me say I have a simple statement of cash flows. Remember, I have these following activities. Now, let me start with operating activity. I think it's not clear enough. Now, let's assume we are making use of the indirect method. All things being equal, probably we have profits for the year. We have adjustments for non-cash items. We have things like depreciation. We have things like loss on disposal of assets. Okay, you add back your income taxes because there might be element of deferred tax in it. And let me just stop there. Let me get my calculator. 500 plus 100 plus 20 plus 40. I think that shows 660. That shows 380. Okay. Let's look at changes in working capital. Remember, these are just hypothetical figures. Okay, we have increase in inventory. That would deplete your cash. There was a decrease in trade receivables. Let me say 40, 12. The decrease in trade payable. Okay, let's leave that. That gives us our cash flows from operating activities. This primarily gave us 324. And the other one, 660 minus 105 plus 40 minus 10, give us 585, hypothetically. Tax paid, that gave me my net cash generated from operating activities. 585 minus 22 gave me 563. And 324 minus 16 gave me 308. Investing activity, let me say the only thing they have there is proceeds on disposal of PPE. Let me just say 80, 30. And let me say they have purchase of software. For example, let me say 40, 22. And that gives me 120 and 52. That is net. Okay, sorry, that's not correct. Purchase is the utilization of cash, and therefore I have to put it in brackets. That is negative cash flow. That gave me 40 and 8. It's still net cash generated from investing activity. The final activity, financing activity. Let me assume what we only have is dividend paid. $15 and $7. And that is my net cash used by financing activity. That's 15 and 7. So my figure 3. Now, hypothetically, what is our net increase in cash? Our net increase in cash will be my figure 1 plus 2 plus 3. 563 plus 40 minus 15. That gives me 588. And the other one is 308 plus 8 minus 7. That gave me 309. Now, what is my cash and cash equivalents? First of January 2019. Let me say it is 250 and this 108. Therefore, all things being equal, my cash and cash equivalent as at 31st December 2019 will be 309 plus 108. That's 417. And 588 plus 250, that is 838. Now, imagine this is what was given to us. This is what was given to us as the statement of cash flow. Now, to consolidate, what do? Your consolidation, if you remember, we said you will have to consider that of the parent, that of the subsidiary. And when necessary, you make what? Adjustments. Let us imagine for once, which is practically not possible, that there is no transaction in that year, no single transaction that cut across the parent and subsidiary. The group position will have been merely adding this together. Remember, there's a premise to which you have said that there's no transaction between the two of them. Please check my figures if it's correct. $588 plus 309 250 plus 108. Okay, this is just an assumption that within the group, there's no transaction that will have given rise to group adjustments, which means here, no adjustments across the group. Everything is nil. But that is not the reality of the day. That is not the reality of the day. But what we need to take note is, we need to take note that in a group, there are possible adjustments that might come across. And what are the adjustments that we may come across? are 4 in number. 1, adjustments regarding treatment of NCI within the group cash flow statement. Treatments of associates and joint venture. Treatment of acquisition of a new subsidiary. And treatment of what? Disposal of a subsidiary. These are the 4 critical adjustments that we are going to consider in the whole process of carrying out consolidation of the statements of cash flows within the group. If there's any question, you can ask. We are here to start. What I've just done is to refresh our memory about how we present the statement of cash flow of a single entity from the perspective of the indirect method. And if there's no transaction between the parent and subsidiary, it will have been merely addition of line-by-line item within the statement of cash flow of individual entities involved in the group. Okay, now let's now go to the reality of it, and let's pick them one by one. Let's start with the adjustments. The first adjustment we are going to treat is what role does NCI play within the group's statement of cash flows. Let's go back to our material. Now, with respect to non-controlling interest, I want us to refresh our memory by answering the question about what do we mean by non-controlling interest. Who will attempt to answer that question? What is non-controlling interest? What is non-controlling interest? You can show up by raise of hand. I wait 1 or 2 people. Or do you want me to call names? I want 1 person or 2 to raise up his or her hand. Okay, Governor, go ahead. Governor, can you go ahead? Unmute yourself. Are you there? Okay, Ogundalu, can you go ahead?
Okay, according to my own, can you hear me?
I can hear you.
Okay, according to my own understanding or what I can remember, non-controlling interests are ordinary shareholders or shareholders in a company that has interest below 20%, any interest below 20% and above 5%, I think.
Okay, thank you, Ogundalu. Please, you can go ahead also from your perspective.
Okay. Good evening, sir. Can you hear me?
I can hear you.
Yes, sir. I would say non-controlling interest are the shareholders who have shares in the entity other than the parent company.
Okay, thank you very much.
Yes,
Yeah,
sir.
which means in summary, non-controlling interests are interests in a subsidiary other than that of the parent entity. Okay, now, the only impact non-controlling interests play in the whole process of consolidated statement of cash flow is for us to identify the amount of dividend that was paid to non-controlling interest. Which means what is much more important is the amount of what? Dividend that is paid to it. And that is what I've tried to show you here. Therefore, if there's no dividend paid to non-controlling interest in a year, it has no impact or consequence in the whole process of presenting consolidated statement of cash flows. But where there is, we need to determine the amount of dividend. And to do that, whether we use a T format, which I'm not favorably disposed to, or we use a vertical, which is the modern day process of accounting, we are going to arrive at the same figure. Now, the first thing is non-controlling interest is equity sitting within the group, but it is the equity attributable to other shareholders that is considered separate from the parent. Now, what then do we look out for? You understand that for non-controlling interest to be equity, primarily it has a credit balance. And that is why you find out that the opening balance to non-controlling interest, whether based on amount of dividend expected or the equity value of NCI, they are on credit side. Okay, why their closing balances with respect to dividend payable to it or with respect to non-controlling interest equity portion is on the debit side. Now, when they share profit, profit increases this value. That is why you see share of profit coming on the credit side. Otherwise, if they are sharing losses, loss comes to the debit side because it's a reduction of the equity value. Okay, and anytime dividend is paid, the dividend is a reduction of the equity value of NCI. That's why it's a debit item. Okay, now to do it in much more modern day accounting is for me to acknowledge that there are two balances that may be attributable to NCI. The major balance is the equity balance, which is the one you find in the balance sheet as the amount of equity attributable to NCI. Now, the other balance you can see is within the current liability where there's a dividend payable to non-controlling interest along with other shareholders. The addition of the two gives the balance that the NCI has within the group. Now, during the year, anytime there's a share of profit, it increases that value. But anytime there's a share of loss, it decreases that value. Now, when you now compare the sum of this value against the balance at the end, both for the dividend payable and both for the equity value, the difference there, which is the balancing figure, represents the amount of dividend that is paid, similar to what we have here, which means regardless of which of the process you adopt, you are going to get the same result. Now, how do we demonstrate that understanding? As simple as what we have shown it is, I'm going to demonstrate it by this simple question. And that question will give us more sense of understanding. Now, I want somebody to volunteer to read this question, and let's use it to demonstrate our understanding. Who volunteer to read this illustration one? Okay, Guinea Kachi.
Good evening, everybody.
Good evening.
Yes. Okay. Question. Illustration 1. Given the following information from the consolidated financial statements of EVA for the years ended December 31, we have 2018-2017. Dividend payable to NCI in brackets declared before year end, 50 for 2018, 80 for 2017. NCI share of group net assets, 390 for 2018 and 345 for 2017. NCI share of group profits for the year, 60 for 2018, 115 for 2017. Required, determine the dividend paid to NCI in the year and disclose how it will be treated in the consolidated statement of cash flows.
Thank you very much.
Okay.
Now, let me copy that. Okay. Now, this is a question before us. The question then is, how do we determine the amount of dividend paid and how do we report that? The first question is the dividend paid to NCI. All figures in Naira. Now we start with the balances brought forward. What are they? The first one is the equity value of NCI. The second one is the dividend payable to NCI, if any. Now, what is the equity value? The equity value, which is the share of the group net assets, was 345 at the beginning. Remember, 2017 comes before 2018. That is 345. Why the dividend payable stood at 80. All things being equal, this is 425. Now, during the year, there was share of profits. Now, what is relevant? Is it 2018 or 2017? Remember, our position is that we are treating our statement of cash flow for the current year. And the current year is 2018 because it is the most recent year when you compare the two. And therefore, what is relevant is that since we have share of profit is an addition, which means it will increase the equity value. Share of post-acquisition profits in subsidiary. And that gives us 390, or what? Sorry, that gives us 60. And when we compare that, that is 485. We compare 485 with our balances that will be carried forward in our books based on one, the equity value of NCI as at the reporting date, and two, the amount of dividend payable, if any. And from the question, what do we have? Our dividend payable is 50, our equity value is 390. Therefore, I'll have it here, 390 and 50. That should give me 440. Now, if dividend is not paid, the sum of this value should equal this value here. But because dividend was paid, the value at the end reduced by how much? By the amount of dividend paid, which is 45. Which is our balancing what? Figure. Because the only thing that can reduce the value, assuming there's no non-controlling, there's no impairment loss, would be the amount of dividend paid out of the profit to the non-controlling interest. The second question is, how do we treat? Dividend paid to NCI should be treated as a cash outflow from financing activities. Does that give us clarification now? Therefore, dividend paid to non-controlling interest within the consolidated statement of cash flows will be considered an outflow, which means a reduction in cash flow within financing activities. Any question at this point? At every point in time, any amount of dividend paid to NCI qualify as a financing activity, and it results in an outflow of cash. Okay, if there's no question, we'll go back. Okay, there's question. Okay, Adegoke, go ahead.
Hello,
Can
good
you unmute
evening.
yourself? Yeah, good evening.
Can you hear me?
I can hear you.
Okay, actually, I don't understand where you got your plus share of profits before tax, that's of 2017. I was thinking you would add 115 to make up the total, what's called total figure for NCI for the year 2017. But I didn't see anywhere you imputed the 115.
Okay, first thing is 115 is the share of profit 2017. We are not dealing with 2017. We are determining dividend for the current year. I was paid to NCI. And between 2017 and 2018, which year is the current year?
2018.
Yes. And we have said what we needed to determine that is the opening balance. Opening balance in 2018 is the balance as at, let's say the year end 31st. Okay, is even there, 31st of December 2017. Which means what is relevant in 2017 are closing balances, not P&L item or share of profit item. Are you getting it now?
Okay, closing item. Is the profit not the closing item for the year? I didn't know I entitled
for the year, which is already embedded in 345.
Oh. Okay.
They've given you the value of NCIs at the end of the year. Will you still add the profit again to the value when deriving the value from your knowledge of group account is that profit or loss is already inside it?
All right, thank you.
Did you get it now?
Yes, thank you.
Which means not necessarily all information provided are usable. Your understanding will also select what is relevant from what is not relevant. Okay, thank you for that. Now let's move to the second one. If we go back here, we've dealt with treatment of NCI. The only treatment method on NCI within the group statement of cash flow is ascertaining the amount of dividend paid to NCI, which will be treated first as a financing activity, second as an outflow of cash because it was paid out of the group. Second one is treatment of associates and joint venture. The treatment is the same for asset and joint venture because in line with IAS 28, both are treated in similar manner with the aid of equity method. Now let's go back to our material. There are three key things we need to consider with respect to associates. The first key point there is to also determine how much is the dividend we received out of the profit of associates. What does that mean? Remember, associate is an investment to us, and we invested in an associate in order to earn returns. And one of those returns that we earn, which is paid out in cash, is the dividend. Therefore, what amount of dividend have we received in an associate? And such dividend will be treated as an investing activity. And secondly, the dividend will be treated as an inflow of cash because we are receiving it, which means we must take note of that. Dividend received from an associate is a financing activity, and two, it represents an inflow of cash. Having done that, the second thing is, it's possible that trading occurs within the group such that the parent or the investor in this case and the associates have balances across one another. And where such balances exist, it may affect the amount that is shown as decrease or increase in items such as trade receivable and items such as trade payables. And therefore, that also needs to be taken into consideration. And we're going to see that there. Okay, so that similar things that we'll have done with regard to elimination of intercompany balances may be melted on this. Also, part of the trading year is that there might be intercompany or loans whereby we consider that there are movement of cash flow between the parent or the investor and the associate in this case. How do we treat that based on the consequence of it in the cash flow statement? And finally, what if there are further investment or divestment you made in an associate, such as you added more investment to acquisition you made in the associate, or you reduce your stake in an associate by selling part of your shares? Of what effect does that have in that? Now, I want someone to volunteer to read this expression out in addition to what I've discussed so far, and we can move on from there. Who will volunteer? Okay, please go ahead.
Dividends received from associates should be included.
Before then, start from the treatment of associates.
Okay, the treatment, okay. The cash flow of associates in the group are reflected the extent that 1, the dividends are received out of profit of the associate. 2, trading occurs between the group and associates, or further investment or divestment is made in the associate. As associates are accounted under equity method of accounting, the cash flow of an associate should be included in the group cash flow statement only to the extent of the actual cash flow between the group and the entity concerned, that is the associate, which include dividends, cash dividends received from associates, and loans made or repaid. Dividends received from associates. It is only dividends paid which represent a cash inflow that will be considered. Proposed dividends declared before the year-end balance sheet date represent an increase in group receivables, that is, share of dividend payable which is received by the investing company will not form part of the assets. Investments in associates but will be included in group receivables. Thus, in reconciling group net cash inflows,
Hello, can I hear you again?
so group profits before exclude proposed dividends from the associates, so that dividends received, cash received from associates should be included as a separate item in the group statement.
Okay, I think our network is bad. Who can continue from dividend received from associates? Okay, Pythagora.
Dividend received from associates should be included as a separate item in the group statement of cash flow under investing activities. Trading between group and associates. Intercompany balances always result from trading between the group and an associate, as shown in the group statement of financial position. These balances should be treated in the same way as any other trading receivables and payables. That is, the balance sheet movement forms part of the reconciliation between group profits before tax and group net cash inflows from operating activities. This depicts that when cash is received or paid in respect to intercompany balances, the cash is included in the cash received from customers or cash payments to suppliers section of the statement of cash flows. Invariably, it will be appropriate to some extent to show separately the cash flows from group customers and suppliers. Let's see this.
Okay. Now, let's look at investment in associates. How do we determine the dividend we are talking about? Okay, similar to what we have done under NCI, we also look at associate account. Unlike NCI account, which is seen from the equity perspective as equity, associate account is seen from the perspective of the investor or the parent in this case as an asset account because it's an investment we have in it. And therefore, our opening balances will be considered to be debit item. And the opening balances include balance regarding dividend receivable, if any. But the most important balance there, which is sacrosanct, is the carrying amount of our investment in associates, which also is a debit item because it represents an asset. Now, peradventure, at the end of the day, we have profit in an associate. We take our share, which invariably increases the value of our stake in associates. Otherwise, if it's a loss, it decreases that value. Now, if it's dividend, anytime we receive dividend from the associate, it's going to decrease our value. And thereafter, all what is left should represent the balance on the associate with respect to dividend receivable and carrying amounts. But to determine the dividend received as a balancing figure, let's look at it from the vertical angle. We have our opening balances, which represent an asset, which is investment, both at the point of dividend receivable and at the point of our investment, which is measured based on equity method at the carrying amount. Peradventure, we have profit. We share profit in the associate, and that increases the investment. If it's a loss in a year, it reduces it. At the end of the day, all of this sum of the first four items should sum up to what we have as our balance carry forward for both dividend receivable and carrying amount. But if they are not in agreement, the difference there representing the balancing figure will account for any amount of dividend received, given that there's no impairment loss on it. Now, to demonstrate that, take note also that it's not only dividend, there are some other transactions between the associate and the investor that have to be adjusted for as deemed appropriate. And what we are going to do is that we will use the second illustration to explain further situations where, apart from our investment in associates, we have dealings with the associates such that we give loan to the associates, and how does that affect our cash flow position? In that manner, I'll give this question. I want somebody to read this question for us to use that to depict our understanding of this. Who will volunteer to read? Okay, Sir Patagora, over to you.
Illustration 2. The following is an extract from the consolidated financial statement of Lilly for the year ended December 31st, 2018. Consolidated statement of profit or loss. Operating profits, 1,468. Share of associate profits, that is after tax of 108,000. That is 136. Profit before tax, 1,604. Tax, parent and subsidiary, 648. Profit for the year, 956. Consolidated statement of financial position. Investment in associates, that's carrying amount 913, that's for 2017, and 932 for 2018. Loan to associates in 2017, that's 600, while for 2018, 760. Current assets, account receivable, for 2017, we have 380, while for 2018, we have 520. Dividend receivable from associates, we have 58 for 2017 and 96 for 2018. Current account with associates, in 2017, we have 140, while in 2018, we have 80. Required, show the relevant figures to be included in the consolidated statement of cash flows under appropriate heading, in bracket activity, for the year ended December 31st, 2018, and the amount at which account receivable will be shown in the reconciliation of profits to net cash flows.
Okay, thank you very much for that. Thank you very much. Okay. Now, what we need to do is that we should show extract of how this whole information, especially as regards the associates, affects our consolidated statement of cash flow. Now, let us start with the first item that is easily known to us. The first item there that we need to understand is dividend received from associates. We start with our balances brought forward. And these are balances brought forward as at the beginning of the year, 2017, which is as at the end of 2017. Now, you have to be careful in examination. You discover that here they've alternated it. 2017 is coming first, and 2018 is coming next. In the last question, 2018 is coming first, 2017 is coming next. Don't ever assume, look carefully, because that singular mistake can make you mess it up. Now, what's our closing balances as at 2017, which serve as our opening? First, we have the aspect of carrying amount for associates, which is the equity value. I bring it forward. The equity value and the dividend receivable. How much is the equity value? The equity value as at 2019 is 912. Dividend receivable, which is a component of account receivable, according to the information here, is 58, all as at 2017, which constitutes the opening balance in 2018. That is 970. Now, in 2018, there was share of profit. And the share of profit after tax is 136. If I come here, I say share of what? Profit. Share of profit of 136 will increase my investment in associates from 970 to 1106. Thereafter, I'll compare that with my balances that are to be carried forward, which is as at 31st December 2018. And these balances are made up of the equity value and the dividend receivable. What are they? The equity value at the end is 932. and the dividend receivable at the end of the year is 96. If I add that together, 932 plus 96 will give me 1028. What that signifies is that if dividend was not paid and there is no impairment loss, 1106 should have been the same amount when you compare it with this. But in this case, it is not. And therefore, what is the difference? The difference between 1106 and 1028, 1106 and 1028 is 78. That 78 represents the amount of dividend received from associates, which will be treated as an investing activity. That is one. But that's not all of it all. There are transactions between the parents. Somebody said you cannot see the writing again. Are you sure? Can anybody confirm? Can you see can you see what I'm sharing? Okay, thank you. Somebody said it is clear. Probably your network may have accounted for that. Okay, now when we go back up, you find out that there are other transactions. What are the other transactions? There's a loan between associates and the investor. You find out that loan to associates was 600 in 2017, now 760. Who can tell me what has happened and how should we treat that in our consolidated statement of cash flow? Who will assist me? What has happened so that the loan to our associate has increased from 600 to 760? And how do we treat such? Zoba, over to you.
It means, good evening.
Good evening, sir.
The loan to the loan, cash there's been outflow of cash in the form of loan to the associates. So it means cash has left, and that may be treated in investing, that under investing activities.
It's a loan to associates. Now, what is the increase? The increase is the difference between the loan to associates in 2018 and loan to associates in 2017. What is the difference? In 2018, the loan to associates is 760. In 2017 is 600. Therefore, the difference between 760 and 600 is 160. An increase in loan to associate is what? An outflow of what? Of cash, which is a form of what? Investment activity. That is the next thing. Now, when you look at this question also, let me enlarge it well and put it to us. Who can tell me what implication now exists? What amount are we going to show as working capital changes with respect to increase or decrease in account receivable? Remember, if you go back to the introduction I did, if you go by way of indirect method, you find things like decrease in trade receivable, increase in inventory. Now, the only information we have in this question is account receivable or trade receivable. Now, is there increase or decrease in trade receivable in the year? And by what amount is such an increase or decrease? And how do we treat such? Under what activity? Operating, investing, or financing? Who is ready to answer that question? Who's ready to answer that question? Zuba, over to you.
So the account receivable would have increased from the account receivable would have increased as a result of the loan that was advanced to the associate, which is the increase, the additional loan that was advanced, which is that 160. So it would have increased by 160.
Now, let me assist you. The loan to associate is part of investment in associate. It has nothing to do with account receivable. You can also see it from the question. Account receivable is a component of current assets, while the loan to associate is part of investment in assets, which is non-current assets. Can you check once again?
Okay.
Who else? Who else?
Current account.
Okay, Owolabi.
Yeah, hello everyone.
Yes, hello, Owolabi.
Yes, I believe the trade receivable, the increase in trade receivable has to do with the movement in activities which has to do with buying and selling between the associates and the which is the parent, the associate and the entity we are preparing the group account for. So the balances has to be classified under the operating activity based on my knowledge.
Okay, what is now the amount that should be reported? First, is it a decrease? Is there an increase? And by what amount?
Like I'm trying to check from because I'm using my phone, but I can't really see.
Okay, no problem. Omo Tolani Dada.
Hello, good evening.
Yes, good evening, yeah.
Okay. Yeah, it's an increase in receivables and it should be added because cash, sorry, it should be subtracted because cash has gone out. So as a result, there's a reduction in our cash. So it should be subtracted.
From where?
From the investing activity.
Are you sure?
Yes, from the investing activity.
Okay. Receivables, trade receivable, trade payables, are they component of investing activities? Let's likely check what we even did today in summary.
Oh, let's check.
I think it's a component.
Oh, there are changes in working capital. Sorry. There are changes in working capital.
And it's a component of what activity?
Operating activity.
Okay, now by how much has it increased according to you? 160. Which 160? How did you get 160?
That's the difference in the amount for 2017 and the amount for 2018.
We are displaying it. Can you call the amount that you are comparing?
Okay, the amount for 20, the amount is 760 and
no,
600.
You are talking of loan. We've dealt with loan.
Okay, sorry. The amount is 520 and 380.
Okay, the difference between it, which is how much? I think it's 140.
140.
Okay. Are you sure?
Yes.
Okay. What is now the role this dividend receivable from associate and credit account, which are included in that account receivable, what role do they now play if you are still saying the difference here? Remember, they told us that accounts receivable included in group receivable are the following amount. Dividend receivable from associate and credit account with associates. That means those two items that are included in it have no effect. Do you consider the effect they might have? Okay, let me give opportunity to somebody raised up hand now. Who will that be?
All right, sir. Because the account receivable is broken down into two further divisions, then we need to treat them separately. Firstly, the receivable from dividend receivable, I believe should be treated under the investing activity. So it means the increase in dividend receivable of the difference between 996 and 58 should be added back as an outflow in the investing activity, while the current account balance has to do with the intergroup balance. Oh, sorry, the balance between the associates and the reporting entity, that would be reported under the operating activity as an increase, which will be added back.
Okay, now let me break it down clearly. Now, let me break down our account receivable into the following. Breakdown of account receivable. (2017) and 2018. Accounts receivable can be broken down into the following components according to information. Trade receivable, third parties, dividend receivable from associates, and the third one, current account balance with associates. Now, if you go by the question, the initial balance was 380 in 2017 and 520. Okay, and this 380 included 58, which belongs here, and 96, included 140 and 80. Therefore, the balancing figure will be the third item, which is the normal receivable to third parties. This is the balancing what? Figure. And can we find the balancing figure? Where's my calculator? That is 380 minus 140 minus 58 will give me 182. 520 minus 80 minus 96. That is 344. Now, this is the breakdown. Now, the first thing you need to know is that this is no longer required because we have used it up. You can't eat your cake and have it. Why? This 98 This 96 and 58. Remember, we use them here. Where is it? This is it. 58 and 96. We can't still double count them and use them in comparison again here. Somebody said she can't hear me. I think probably it's your network. Okay. Now, the second one is current account balance with associates. Does this have effect? The answer is no. What someone will have said is that when you have current account balance with associates, you should eliminate it. But the answer is no, you don't eliminate it. Why? Because you neither consolidated it in the first place, therefore you can't eliminate. In that situation, what are going to happen is that this 140 and this 182 are what is relevant. 140, which is 2017 balance, which you want to compare, is 140 and 182. We'll compare that with 2018 balance, which is 80 plus 344. The answer we get from there is what will give us the increase in account receivable. Because if we fail to remove this 58 and 96, we'll be double counting, because we have used that 58 and 96 for investment in assets to determine the actual dividend received, and you are still making use of it as component of the movement in your working capital, which will not be correct. Therefore, 140 plus 182 will give me 322. And 344 plus 80, 344 will give me 422. And what is the movement? There's an increase in 2018. By how much? By 102. And this increase will be reported within the changes in working what? Capital. Under what? Under operating what? Activity. And that is the rule that need to play in that case. Any question on that? Any question on that? Ogundalu, over to you.
Okay, sir. So, like, I'm sort of lost in this explanation of the account receivable. So, I was thinking, accounts receivable. Why? Okay, trade receivables. Okay, maybe I understand now, because I was thinking, you wrote trade payable. So I'm not just so clear on the breakdown on how you broke down the account receivables. If you can come again on how you broke down the receivable and why the increase in accounts receivable is part of the operating activity of the group.
Okay, let me start from the last one. I think you are aware that operating activity is your core activity, and your trade receivable emanated from your trade, your main operation. And that's why it's operating activity. And also, if you go back to our discussion earlier today, where I tried to refresh your memory about single cash flow of both parent and subsidiary, you can see that the changes in working capital is a section or component of operating activity. And I believe that should answer that question. The second question is, you said, how do I break it down? My breakdown is based on the information provided to me. And let me enlarge so that I can see the information clearly once again. The information provided to me shows as follows. That included in, they gave us account receivable of 380 and 520. They now said, included in group receivable are the following amounts. That is, as part of this 380 and 520 are dividend receivable, and current account with associates, which means if I remove 58 and 140, anything left is normal trade receivable. That is what I've done. Does that answer your question now? Ogundalu, does that answer your question?
Yes, sir, I'm clear. I'm clear.
Okay, thank you.
Yes.
Any other question? Now let's look at the next one. Acquisition and disposal of subsidiary during the year. Now, do you know the implication? The implication when you acquire subsidiary during the year is as follows. I want somebody to read this and I will explain it. Acquisition and disposal of subsidiary during the year. I want somebody to read it and I will explain it with practical illustration. Omotolani.
Okay. Hello, sir. Okay.
You can go ahead.
Okay. When a subsidiary joins or leaves a group during the financial year, the cash flows of the group should always include the cash flow of the subsidiary concerned for the same period as that for which the group's income statement includes the results of the subsidiary. That is, from date control exists or control is lost or part of the holdings in the subsidiary is disposed of. Payments to acquire subsidiaries and receipts from disposals of subsidiaries must be reported separately in the statement of cash flows under investing activities. They are reported in the statement of cash flows, net of cash and cash equivalents acquired or disposed of. A note to the statement of cash flows should also show summary of the effects of acquisitions and disposals of subsidiaries, disclosing 1, the total purchase or disposal consideration, 2, the amount of cash and cash equivalents included in the purchase or disposal consideration, 3, the amount of cash and cash equivalents in the subsidiary acquired or disposed of, 4, the amount of the assets and liabilities other than cash or cash equivalents in the subsidiary acquired or disposed of, summarized by each major category. Implication of acquisition or disposal of subsidiary on consolidated statement of cash flows. The substance of an acquisition of a subsidiary is that the group has purchased the assets of the subsidiary. However, in statement of cash flows, we only wish to record the actual cash flows. Thus, for example, the additional non-current assets under the control of the group as a result of the acquisition will not be separately stated under the heading investing activities. Due care needs to be taken when expenditure on non-current assets is derived as a balancing figure. Non-current assets of the subsidiary at acquisition must be included in the ledger accounts used to derive the balancing figure. The same caution is required for other assets and liabilities in the subsidiary at acquisition.
Thank you very much.
Yes, sir.
Now, what does that signify? I'll use a simple illustration to explain that. Okay, now let's look at this illustration. Given the following information, the group inventory included subsidiary acquired during the year, and they gave us the balance as at the end of the year. We also have group inventory, which excluded the subsidiary acquired in the year. They gave us 2008. Now, during the year, they gave us subsidiaries inventory, which included the net asset acquired in the year, which is 30. Now, what does that imply? Let me explain what they have tried to do, or what they are trying to explain to us. Now, let's look at, this is 2018. Okay, 2008. 2008, we only have the parent, and we have the subsidiary. And the sum of what they have is 400. In 2009, we now have the parent, the initial subsidiary 1, and now they've added subsidiary 2. And the value then is 500. Now, you know, if you just want to go by convention of looking at movement in the value of inventory between the beginning and the end of the year, you will have erroneously say the movement here is that there's an increase of how much? 100,000. But if you do this and say there is an increase in inventory for the group, what you have done is totally wrong. Why is it wrong? It is wrong because you are not comparing apple with apple. What is the apple? At the beginning of the year, you only have these two constituting the balance. Why at the end of the year, you have what? 3 constituting the balance. Now, if you compare these two together, you are comparing what is not. Therefore, what do we need to do is for us to say, okay, as at the time we acquired the subsidiary in 2009, what was the amount? What was the fair value of the inventory acquired in the new subsidiary? And that amount is what we are giving to that the subsidiary inventory, which was included in the net asset acquired, was 30. Or because as at that time, when you acquired that subsidiary, the value of the inventory acquired in that subsidiary was 30,000. Therefore, if that is the case, we can ask, okay, imaginarily, let's assume that that subsidiary was existing as at the beginning of the year. If that is the case, this value of 30,000 should have been existing along with it as at that date, such that at the end of the day, we will now say our 2008, we have P, we have S1, and we have S2. And by doing so, what we have is 400, which is for the initial 2, plus 30, which is for S2. Doing so will give us how much? 430. And we can easily compare that 430 with that balance in 2019, which is P plus S1 plus what? S2, which is 500, because that has been incorporated. Now, what is the movement now? The movement now is an increase in inventory. Which is how much? 70,000. As opposed to what? This is correct. Why this is not correct? Which means you must compare apple with apple. How many entities constitute the balance last year with how many entities constitute the balance this year? If they are not the same, you have to make relevant adjustment. If it's for acquisition, what you need is what was the fair value to which the asset or liabilities of that subsidiary was acquired during that year. That amount will be adjusted against the opening balances, as I've done in this case. It is that adjusted opening balance that you cannot compare with the closing balance, and you compare the difference, apple to apple, to determine what actually is a true increase or decrease in inventory, in trade receivable, in trade payable, in fixed asset, or any form of asset and liabilities of the group. Any question on that? Which means in this case now, the answer to the question is what will be the increase or decrease to be shown as a reconciliation of group profit before tax to net asset inflow from operating activity. Anybody that chose 100 as increase will have missed it. Rather, it is 70. 70 because we have adjusted for the subsidiary that was newly acquired in the opening balance. Any question on that? Now, if that is the case, how do we harness same knowledge with Zoba? Over to you. There's a question you want to ask.
Yes, my question is, how did we come about the 30? Is it hypothetical? 30,000.
The 30 is not hypothetical. The 30 is in the question. Can you read it?
Let me see. Oh, okay.
The subsidiaries inventory, which is included in the net asset acquired in the year, was 30. That is the new subsidiary.
Yeah.
Okay, now we'll look at another exercise to deepen that understanding. This one will deal with assets, like item of PPE. Okay? You'll be the one to read this question now.
Given the following information.
Just wait. No, not that. I'm sharing a wrong slide. Okay, illustration 4. Over to you.
NIA acquired Farayola in the current accounting period. Extras from the group account of NIA shows for the year ended 31st December 2017 and 31st December 2018. Non-current assets in thousands of naira, 20,000 for 2017 and 32,000 for 2018. Depreciation of 5.2 million naira was charged to the consolidated income statement in the year, and the net book value of non-current assets disposed of is 1.2 million naira. The fair value of Farayola's non-current assets when Farayola was acquired by NIA stood at 9.6 million naira. Required, determine the group's expenditure on non-current assets during the current accounting period.
Okay. Now, what is the question all about? Now let's compare the balance. PPE. Or figure in thousands. What's the carrying amount of our PPE? Carrying amount as at the beginning. balance brought forward. What do we have? This 2017, this 2018, therefore opening will be 2017. Now, in this 2017, we are told that depreciation of 5.2 million was charged to consolidated income statement in the year, and the net book value of non-current asset disposed of is 1.2. Okay, the fair value of Fariola non-current asset when Fariola was acquired by NIA stood at this amount. Now, okay, now what's our balance here? During the year, there was addition. What is our addition? Addition is the fair value of near PPE at acquisition, which we are going to add to it. And what was the fair value then? 9.6. Therefore, we have compared apple with apple now, which is 29,600. Now, during the year, there was depreciation. Now, if you deduct depreciation, it should reduce your balance. What is the amount of depreciation? 5.2. If you dispose of an asset, the kind amount or net book value of that asset the net book value must be yanked off, and we are told that the net book value is 1.2. If you deduct this, therefore what you have deducted is 6.4. 6.4 should be our expectation of the kind amount as at the end of the year. And that should be 29,600 minus 6,400. That's 23,200. Now, but what is our carrying amount? As at the reporting date, the actual carrying amount. The actual carrying amount is 32,000 or 32 million, since all figure is in thousand. We'll now compare this and this. What you can see is that there's an increase in the value. By how much? 8,800. And that represents my additions by way of cash to our PPE, which means if we have not bought PPE additional shares, it wouldn't have been 32, it should have been 23.2. But as at the end of the year, we have 32, which shows that there's an additional asset to the tune of 8.8. Okay, I was told that I'm not sharing the slides. Sorry. This is so painful. Okay, I was not seeing your chat. Okay, now let me show you again. Remember that 20,000 was our balance brought forward in 2017, which is this. During the year, Fariola was acquired and its fair value of the asset was 9.6, which is this. And this is similar to the operation we did here by adding the fair value to your opening balance. And that's what we have done here to add 29,600. But you know that depreciation reduces the value of your assets. You are also aware that disposal of assets, the book value of it must also be yanked out or used to reduce the value of your asset. In total, we have reduced it by 6.4. Now, if there was no addition to the asset during the year, other than the disposal that has happened. Therefore, the balance should have been 23,200, which is our expected carrying amount. Whereas our actual carrying amount in this case was 32, based on the information we have in the question. It then means that the difference is because there have been new cash purchases of assets in the year. And that is to the tune of 8,800. Now, who will tell me in which section of the cash flow are we going to report this 8,800? And are we going to report it as an outflow of cash or as an inflow of cash? Zoba.
So this is going to be reported in investing activities as outflow of cash.
Outflow of cash. That is 100% correct. Thank you. Any question before we move further? Okay. Let me see whether we have one more illustration before we go into the work of the day. Now let's look at disposal of this. Okay, can somebody read this first before I go into disposal with illustration? Can somebody read it? Who will volunteer? Dada?
Disposal of a subsidiary is treated using the same principles as for an addition. Cash flow in relation to disposal of a subsidiary from the group perspective is to the extent that cash is received as consideration. This will be shown as an inflow under investing activities. If any group assets or liabilities are being analyzed to determine a cash inflow or outflow, the book value of the subsidiary's assets / liabilities will need to form part of the analysis. For example, tax liabilities in the subsidiary at the date of disposal will represent a debit in a taxation account written up to determine tax paid.
Okay, I'm going to use an example to do that. Let me just pick a hypothetical example. Okay, the hypothetical example I'm going to pick is, let me pick this. Let me just pick this illustration. I will modify it. I'll modify it. Okay. Let me modify the question. Let me paint it. Okay, I've modified the question. Can somebody read the question now? Based on this modification. Okay, let me enlarge it. Okay, Adeleke, proceed.
Hello? Hello?
You can proceed. Hello?
Hello, sir. Good evening, sir.
Yeah. Proceed.
Illustration 3. Given the following information, group inventory, including subsidiary acquired in the year, as at 31st December 2009, 500,000. Group inventory, excluding subsidiary acquired in the year, as at 31st December 2008, 400,000 naira. Disposed subsidiary inventory, which is included in the net assets disposed in the year, 30,000 naira. What will be the increase or decrease to be shown as a reconciliation of group profit before tax to net cash inflows from operating activities?
Thank you very much. Okay, this is illustration 4. Okay, now what I'm going to do in this case, in similar vein, what we're going to do is to ask ourselves that in 2008, we have, let's say, P, S1, and S2, 3 subsidiaries that make up 500,000. In 2009, we now have P and S1. Why? Because S2 was eventually disposed of during the year. Disposed of in 2016. Therefore, what then now happen? If you compare this with this, we'll be getting it wrong. If you compare 400, sorry, 20, this 400, and this is 500. If you compare this with this, we'll be getting it wrong to say it is 100 increase. Whereas it is not 100 increase. Why is it not 100 increase? It is not 100 increase because we have not taken into consideration the fact that we are not comparing apple with apple. We are comparing 3 entities with 2. Therefore, what do we need to do? Is for us to acknowledge that this is wrong, and rather we adjust for 2, as if it was not disposed of. And doing that means I need to ask myself, what was the kind amount as at the time S2 was disposed of? And the kind amount was 30. Therefore, what will I do? I'll now come back to say, invariably 2008 is P plus S1 plus S2, which is 400. But if as at end of 2009, we have not disposed S2, what we are going to have is plus S2. And what is that value of X2? The value of this X2 is this 30,000. And which invariably means it is what we have here, which was 500 before, plus 30. These 2 will give us 530. All things being equal, the actual difference should have been increment of 130. And this is what is correct, that will be shown in our group cash flow as increase in amount of inventory. Any question on that? Any question on that? Any question on that before we move forward? Okay, Aisha.
Sorry, sir. Please, can you go up to the question again?
Okay, I will. This is a question.
Okay.
Any other question? Any other question? Okay, Adebimpe.
Okay, thank you, sir. So my question, okay. Can you hear me, sir? Hello, sir. Hello, can you hear me?
We can hear you.
Can you hear me? Sir,
Hello?
can you hear me?
Yeah, I can hear you better now.
Okay. So the question, I'm a little bit confused in the question. So you said group inventory, including subsidiary acquired in the year as at 31st December 2019 is 500,000. But in the illustration, it appeared that the subsidiary was not in existence as at 2009, which is supposed to be. So maybe I don't understand the question. I don't
Okay.
understand the
Yeah,
institution.
I know what might have confused you in the question. Remember, we pick question of acquisition and we try to tweak it. Okay.
Yes.
Let me show you what we've done. Okay. Now,
Okay.
see what we have done is that we said the group inventory, including subsidiary, disposed of, not acquired. You know, I question. This is now question on disposal. Let me put it correctly. Disposed of. Likewise, the one beneath also is disposed of.
Yes, okay.
Not acquired.
Okay.
Are you getting it? Do you get it, ma'am? Disposed of. Okay, any other question? Okay. Now let's move further. Now I want somebody to read this question, which is our main question for the day. And this question will more or less encompass all of our discussions. And you have the question in your hand before today. In case you don't see it clearly, you can also. Who will read the question? Volunteer. Okay, Adebimpe, over to you.
Okay, illustration 5. Faramade acquired 80% of the ordinary share capital of URI since incorporation long time ago, and also acquired 25% shareholding in EVA with significant influence obtained immediately. On January 1, 2018, Faramade acquired the entire share capital of NIA. You are provided with the following information regarding the group accounts. Consolidated statement of profit or loss for the year ended 31st December 2018. Operating profits, note 1, 3,961,300. Profit on disposal of property, note 2, 500,000. Net interest expense, note 3, 2,300 in brackets. Share of associate profits in brackets after tax of 30,680, 28,320. Profit before tax, total 4,487,320. Income tax expense, parents and subsidiaries, 2,216,480. Profit for the year, 2 million. Sorry, sir, your cursor is on the figure. I can't see that figure. About 2,840,000. Profit attributable to owners of the parent equity, 2,229,176. Owners of the parent equity, 2,229,176. Non-controlling interest, 41,664, totaling 2,270,840. Consolidated statements of changes in equity, share capital, retained earnings, and total. At January 1, 2018, 3 million for share capital, 6,206,850 for retained earnings, giving a total of 9,206,850. Profit for the year, nothing under share capital. Under retained earnings, we have 2,229,160. Dividend paid, 195,000 in jackets. Issued of ordinary shares, 1,200 under share capital. Then as at December 31, 2018, we have a total share capital of 4,200 million, retained earnings of 8,241,026, and a total of 12,441,026. Okay. Consolidated statement of financial position. Non-current assets, property, note 2, 8,276,718, 9 million, then 9,744,658. Okay, so plant and machinery, note 4. We have two different balances, I guess, for the parent and the subsidiary. That's for Faramadi and URI. Plant and machinery, note 4, for 2,673,400 and 3,955,400. Then goodwill on consolidation, we have 66,500 and 192,500. Investment in associates, 80,750 plus 5 and 98,570. Inventory, 2,069,000 and 3,480,100. Account receivable, 854,200 and 1,250,000. So that's all I can see on my screen. I can't see the remaining. Okay. All right. Okay. Cash, 21,000, 100,000, 21,100 and 136,750, giving a total of 14,037,668 and 18,777,978. Ordinary share capital, 1 naira each, 1 naira per shares in brackets. We have 3 million and we have 4,200,000. Retained earnings, we have 6,206,850 and we have 8,241,026, giving a total of 9,206,850 and 12,441,026. Then non-controlling interest, we have 620,000 and 642,464, giving a total of 9,826,850 and 13,083,490. Can I see the next page? Okay, so non-current liabilities, loan, we have nothing under the first column and we have 150,000 under the second column. Then current liability, we have account payable 984,500 and 1,640,640. Tax liability, we have 3,226,318 under the first column and 3,903,848 under the second column, giving a total of 14,000,000 and 37,668 and 18,777,978. Okay. Okay. All right. So notes to the account. 1. Operating profit is arrived at after charging depreciation amounting to 558,000. 2. Profit on disposal of the property represents profit made on property sales with a net book value of 940,000. 3. Included in net interest expense is interest income of 9,800 received. Also, the interest paid after adjusting for an opening accrual of 600 naira and a closing accrual of 4,600. Machinery, cost, accumulated depreciation, and net book value. At January 1, 2018, we have 3,500,000 as cost, 826,600 as accumulated depreciation, giving a net book value of 2,673,400. Additions ever, we have 1,100,000 for cost and accumulated depreciation of 240,000, giving a net book value of 860,000. Others, we have 980,000 for cost, new for accumulated depreciation, giving a net book value of 558,000. Okay, so the total giving us 5,580,000 for cost and 624,600 as accumulated depreciation, with a total net book value of 3,955,400. Note 5. Associates as at December 31. Cost 2017 we have 72,000, while 2018 we have 72,000 also. Accumulated profit in 2017 we have 8,750, while in 2018 we have 26,570, giving a total of 80,750 in 2017 and 98,570 in 2018. Included within receivables are dividend receivable from associates. December 31, 2017, we have 29,000, and December 31, 2018 is new. Note 6. Acquisition of NIA. Consideration, equity shares, 1.2 million, cash, 600,000, giving a total of 1.8 million. The net asset acquired, plant and machinery, 860,000, inventory, 836,500, account receivable, 449,300, cash, 532,400, accounts payable, 262,000 in jacket, tax payables, 742,200 in jacket, giving a total net asset of 1,647,000 in jacket. So arriving at a goodwill of 126,000. Required, prepare a consolidated statement of cash flow in a form suitable for publication in accordance with the requirements of IAS 7, subject to adjustment resulting from IFRS 3, IFRS 10, and IAS 28. Thank you.
Thank you so much. Thank you so much. Thank you for that reading. Now, okay, this is a question we are attempting to solve. But again, what I want us to do is that this question, we are only going to read it out at this night, which we guys will go back and attempt solving it before we come back again, but not today. And what we are going to do is for us to make use of the little understanding we have today, after you have also revised with the aid of the video, to attempt solving that question. But again, before you solve that question, you must once ascertain that one, you have sound understanding of the requirement of IFRS 3 and IFRS 10 with respect to business combination and consolidation. Second, you must have good understanding of IAS 7, which deals with statement of cash flows, especially for a single entity. Now, that knowledge combined together will be used to attempt solving this problem. And what you're going to do is that this problem will be given to you to solve this night, so that by tomorrow we'll convey at similar time, which I'm going to communicate as soon as practicable, not later than tomorrow morning, where we'll now come back to jointly solve the question and compare it with what we have done. Is that okay? Thank you very much, and God bless you. Have a safe night. I'll share the notes in which we've done today with you guys on your platforms. Thank you. God bless you. Bye.